Before the video will start, LiteFinance has important notice for all IBs from Nigeria. I invite you to participate in Best IB contest. You can win SUVs, $5,000 travel packages, MacBook Pros, and many more money prizes. To participate, register with the link from the description under the video or in the pinned comment. So volatility is a parameter that characterizes dynamics of price changes and the width of the movement range for a fixed period of time. And so this parameter helps to assess how quickly the price changes for the current period relative to the previous ones, or how much the price of an asset changes relative to other assets. So now let's talk about some example. On February 3rd, 2022, Meta's ex-Facebook shares plummeted 26%. And so this is the biggest corporate slide in the US in recent times. And the reason for that sharp increase in volatility was the financial statements, which did not meet investors' expectations, to say slightly. Mark Zuckerberg company has been at the center of scandals related to repeated leaks of users' data, and therefore the loss of individual Facebook divisions and the worst ever predictive dynamics of revenue led to the fact that trading Facebook shares ceased to be profitable. And important to remember is that the volatility parameter is relative. It is always calculated relative to other time intervals or other assets. So now let's discuss the types of volatility. So traders differentiate between low, medium and high levels of volatility. So less than 20%, which is a low level of stock volatility, it shows the optimistic mood of the market participants. The lower the indicator value falls from this mark, the greater the possibility of a quick trend reversal and moving in the opposite direction. And so this is often a signal for the investors to sell securities and close trades. In case of low volatility, it is important to take profits before the upcoming reversal. And now we have the range between 20 and 30%, which is the medium level of volatility. So fluctuations within this range cannot give the investors any signal for action. Now 40% or more is a sign of panic in the market, or high volatility, if you say so. It is usually accompanied by a sharp decline in assets prices. This is a signal for the investors to search for an entry point to the market. As soon as the volatility declines, the share price will go up again. Therefore, this is the best time to purchase securities and other assets. So, note that these levels mostly apply to traditional stocks and options. Cryptocurrencies are stocks with high volatility, so a daily change of 20 to 40% is a common occasion. As for the types of volatility, there are two of them: historical and implied. Historical is the current standard deviation of the price from its average value from the period. The implied one is future volatility, taking into account the historical and possible impact on it of subsequent events. And so next we have realized historical volatility. Historical volatility is a value equal to the standard deviation of an asset's return over a given period of time based on historical data. So the average value is calculated based on the history of prices for the last year. Then the standard deviation is calculated, and the higher the price average value deviates, the higher the volatility. And so now, what historical market volatility provides an investors with? So the width of the volatility range. The investors can predict how much volatility will increase after releasing information based on the market reaction to similar news in the past. For example, investors understand that after the publication of quarterly reports, the volatility of a stock over past 5 years has never exceeded 5%, and so they take into account in the trading system. So the frequency of a volatility spikes shows how often the price reacts sharply to a particular event, what phases it goes through, and how quickly it returns to the average value. And so a duration of a volatility spikes now. For example, the price of one asset rises by 10% on the first day but returns to the average value the next day. So another asset rises by 10% in a week, although such price spikes are not typical. In both cases, there is high volatility, but trading systems with these assets will be different. So based on information on historical volatility, the implied volatility parameter is formed. So now let's talk about this implied volatility, which is a forecast indicator of the price dynamics based on historical values and potential risks. The term occurs in economic theory, but investors do not separate historical and implied volatility in practice. They analyze the dynamics of price changes in the past, estimate the range in the current period, and make forecasts for the future. So, what are the factors affecting volatility? So the reason for volatility can be objective and subjective. The objective factors are the reaction of most traders to an event, for example, the publication of financial data on force majeure. Artificial loosening of the market by large volumes of transactions to move the price in the right direction is a subjective factor. Now, supply and demand. A stable market is one in which the number of sellers and trading volumes approximately match the number of volumes of buyers. So if there is a buyer immediately at a price offered by the seller, it practically does not change. But if there is an imbalance, the price starts to move. For example, with a sharp increase in demand, the sellers cannot satisfy it completely and eventually increase the price. In such a market, volatility is rising. So let's talk about the example. 10 sellers are willing to sell one apple for $2 a piece. 11 buyers come to the market, ready to buy one apple each. If 10 buyers are also willing to pay $2 for an apple, then the buyer who is left without an apple offers $2.1, thereby slightly shifting the price up and getting priority for the purchase. Volatility is low. 20 buyers come to the market, but there are only 10 apples. The price of an apple immediately doubles. Then we can see that volatility is high. Next thing are big news. So fundamental analysis trading is based on news data. If the information corresponds to the forecast, the volatility practically does not change. If the discrepancy is significant, an imbalance in the direction of sellers or buyers immediately appears on the market. An example can be investors' reaction to financial data, shareholders' decision to pay dividends, etc. And so next thing is changes of the weather, natural disasters, or geopolitical events. This volatility factor includes all events that occur suddenly. Any unpredictable event encourages most people to act similarly, namely to sell or buy an asset right away, depending on what happened. A sharp increase in demand or supply leads to a shortage of assets from another participant in the transaction. As a result, the price changes sharply in the short term. Example: the geopolitical conflict involving Russia that began in February 2022 led to a sharp increase in the volatility of the Russian ruble, which occurred in a smaller range in 2020. Next factor is seasonality. The change in seasonal volatility is visible in the long term. The reason is a change in supply and demand in certain periods of the year caused, for example, by the practical use of an asset. Example: at the beginning of the heating season, there is an increased demand for energy, oil and gas. An increase in demand automatically leads to an increase in prices, and so the traders themselves is the next factor. The volatility can be influenced by large market makers who shake the market in the short term, sometimes for their benefit, but occasionally the market reacts unconventionally with increased volatility. Example: at the end of December 2021, Musk tweeted a selfie with his puppy named Floki, dressed as Santa Claus. It was just a pre-Christmas tweet, but investors took it seriously. The little-known Santa Floki ho 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 increased by 5,000% in a few hours. Similar bursts of volatility due to Musk's action in 2021 also affected other cryptocurrencies, such as the popular Doge, the little-known Vikings chain, Vikings Swap, and Space Vikings. Next factor are emotions. And so, one of the reasons for volatility is panic, which leads to an avalanche effect of price changes. It is most often observed during the deflation of economic bubbles and the global financial crisis. Then the market declined by 50% or more. Example: market crash during the dot-com crisis and the mortgage crisis, the collapse of cryptocurrency market in January 2018. So, I guess guys, that would be all for this video. Hope you liked this one, learned something, and I'll see you in the next one.